The S&P 500, a bellwether for the American economy. A collection of 500 of the largest companies, their fates intertwined with ours. Lately, it's been a wild ride. Up, down, sideways, investors are on edge. Will it bounce back? Let's dive in. We're talking trillions of dollars here, folks. Your retirement, your kids' college fund, it's all riding on this. We need to be smart. We need to be informed. We need to understand the forces at play. That's what we're going to do today. We're going to break it down plain and simple. We're going to look at the good, the bad, and the ugly, because at the end of the day, knowledge is power, and in the market, that's how you make money. First things first, we got to check the economy's pulse. Is it healthy? Is it running a fever? Because a strong economy lifts all stocks. Right now, it's a mixed bag. GDP growth is slowing down. Not great, but inflation is cooling off too. After those crazy price hikes, that's good. The Federal Reserve, they're like the economy's doctors. They've been raising interest rates to fight inflation. Problem is, high rates can also hurt growth. It's a delicate balancing act. Keep an eye on those Fed meetings, people. What they say, what they do, it sends shockwaves through the market. Right now, they're saying higher for longer. That means rates are staying up there for a while. Not exactly music to the ears of investors, but hey, there's always a silver lining. Maybe, just maybe, inflation keeps cooling down. Maybe the Fed eases up on those rate hikes. Maybe, just maybe, that gives the economy the boost it needs. Let's talk about the companies themselves, the engines of the S&P 500. How are their profits looking? Are they making money hand over fist, or are they struggling to stay afloat? Earnings season, that's when companies report their quarterly results. It's like getting a peek under the hood, and lately the picture hasn't been pretty. Profits are down, margins are squeezed, it's tough out there. Some sectors are holding up better than others. Tech, for example, they're still raking it in. People can't live without their smartphones and software, right? But other sectors like energy and industrials, they're feeling the pain. High energy prices, supply chain disruptions, it's a recipe for disaster. So what does this mean for the S&P 500? Well, if companies can't grow their profits, it's hard for their stock prices to go up. It's as simple as that. But hey, don't despair. There are always companies out there innovating, adapting, finding ways to thrive. Those are the ones you want to own. It's a crazy world out there, folks. Wars, tensions, uncertainty. It's enough to make you want to bury your money in the backyard. But we're not quitters, are we? The war in Ukraine, it's a tragedy. It's also sent shockwaves through the global economy. Energy prices spiked, supply chains got disrupted, and investors, they hate uncertainty. Then there's China, the world's second largest economy, but they've got their own problems. Slowing growth, a property bubble, and tensions with the US. Not exactly a recipe for global stability. And let's not forget about the 2024 US elections. Political uncertainty, policy changes, it can all spook the market. Buckle up, folks, it's going to be a bumpy ride. The bottom line is this. Geopolitics matter. Global events can have a huge impact on the market. So stay informed, stay vigilant, and don't be afraid to adjust your portfolio accordingly. Section 5. Technical Analysis. Charting the course. Alright, let's get technical for a minute. Don't worry, I'm not going to bore you with fancy jargon. But charts, they tell a story. They show us where the market has been, and maybe, just maybe, where it's going. We're looking for support levels. Those are prices where the market tends to bounce back. And resistance levels, those are like ceilings, where the market has trouble breaking through. Moving averages, they smooth out the noise and show us the trend. Is the market trending up, down, or sideways? That's what we want to know. And then there's momentum indicators like the RSI. Is the market overbought, oversold, or somewhere in between? It's all about timing, folks. Now, I'm not saying technical analysis is a crystal ball, but it can give us clues. It can help us identify potential opportunities and risks, and that's what it's all about. Section 6. History doesn't repeat, but it rhymes. They say history doesn't repeat, but it rhymes. This means that while exact events may not happen again, similar patterns and themes often emerge. So let's take a trip down memory lane, shall we? By examining the past, we can gain insights into the present and perhaps even the future. Let's see what happened in the past when inflation was high, when rates were rising, when the world seemed to be on the brink. These moments of economic turmoil can teach us valuable lessons. The 1970s, those were dark days. Stagflation, they called it. A period marked by stagnant economic growth and high inflation, high unemployment. It was a nasty combination. People struggled to make ends meet and the economy seemed stuck in a rut. The market, it went nowhere for years. Investors were frustrated and confidence was low. Then there was the 2008 financial crisis. Remember that? It was a time of great uncertainty and fear. Banks collapsing, the housing market imploding. It was a close call. Many wondered if the financial system would survive. The market tanked, and it took years to recover, but recover it did, showing the resilience of the financial system. But hey, it's not all doom and gloom. There are always opportunities, even in the darkest times. The market has a way of bouncing back eventually. Remember the dot-com bubble? It was a time of great innovation and speculation. It burst in 2000, and a lot of people lost a lot of money. But guess what? The lessons learned paved the way for future growth. The market recovered, and it went on to new highs. Innovation and resilience drove the next wave of growth. The point is, history can teach us a lot. By studying past events, we can better understand the present and prepare for the future. It can show us what's possible, both good and bad. The key is to learn from these experiences and apply those lessons wisely. But it's not a perfect predictor. Every situation is different. The context, the players, the global landscape, all these factors change. Every market cycle is unique. While history provides a guide, it's up to us to navigate the present with wisdom and foresight. Section 7. Are stocks cheap or pricey? The valuation puzzle. Let's talk about valuation. Are stocks cheap or expensive? This is a question that every investor grapples with. Because at the end of the day, you want to buy low and sell high, right? That's the golden rule of investing. One way to measure valuation is to look at the price-to-earnings ratio, or PE ratio. It's a common metric used by investors. It tells us how much investors are willing to pay for every dollar of earnings. The higher the PE ratio, the more expensive the stock is considered. Historically, the S&P 500 has traded at an average PE ratio of around 15 to 17. This gives us a benchmark to compare current valuations. Right now it's higher than that. This raises concerns about whether the market is overvalued. Does that mean stocks are overvalued? Maybe. But it's not that simple. But here's the thing. Valuation is relative. It's not just about the numbers. It depends on a lot of factors like interest rates, economic growth, and investor sentiment. These elements can significantly influence stock prices. When rates are low, investors are willing to pay more for earnings. This is because they have fewer alternatives for generating returns. When growth is strong, they're more optimistic about the future. This optimism drives higher valuations. And when sentiment is bullish, well, everyone wants a piece of the action. This can lead to a surge in stock prices. So, are stocks cheap or pricey? It's a tough question. There's no easy answer. It requires careful analysis and consideration. But it's something you need to consider before you hit that buy or sell button. Always do your homework and understand the market conditions. Section 8. The mind of the market. Fear, greed, and uncertainty. The market is like a living, breathing organism. It's driven by emotions, fear, greed, hope, despair, and right now, it's a roller coaster of emotions. The VIX, they call it, the fear index. It measures market volatility. When the VIX is high, it means investors are scared. When it's low, they're feeling complacent. Put-call ratios, investor surveys, they all give us a glimpse into the mind of the market. Are investors bullish or bearish? Are they buying or selling? It's all about sentiment. Right now, sentiment is mixed. Some investors are optimistic about the future. They see inflation cooling down, the economy muddling through, and the Fed eventually cutting rates. Others are more cautious. They're worried about a recession, a debt crisis, or some other unforeseen event. They're sitting on the sidelines waiting for a better opportunity. So what's the right approach? Well, that's the million-dollar question. It depends on your risk tolerance, your time horizon, and your overall investment goals. Section 9. The bottom line S&P 500 bounce or bust. So will the S&P 500 bounce back? That's the question on everyone's mind. That's the big question, isn't it? Investors, analysts, and everyday people are all wondering the same thing. The answer, my friends, is, it depends. There are no guarantees in the stock market. There are a lot of factors at play here. It's not just one thing that determines the market's direction. The economy, corporate earnings, geopolitics, technicals, sentiment, it's a complex equation. Each factor can have a significant impact. On the one hand, there are reasons to be optimistic. Inflation is cooling down, which is a positive sign. The labor market is strong, with job growth continuing to be robust. and the US economy is still the most dynamic in the world, driving innovation and growth. On the other hand, there are also risks to consider. Market volatility is always a concern. The Fed is still raising rates, which could slow down economic growth. The war in Ukraine is ongoing, adding to global uncertainty, and valuations are elevated, making some stocks expensive. So what's an investor to do? First, don't panic. It's important to keep a level head, stay calm, stay informed, and stay focused on your long-term goals. Second, diversify your portfolio. Spread your investments. Don't put all your eggs in one basket. Diversification can help manage risk. Invest in different asset classes, different sectors, different geographies. Third, be patient. Patience is key in investing. The market goes up, the market goes down. It's a natural part of the market cycle. It's a marathon, not a sprint. Long-term thinking can help you weather short-term volatility. Don't try to time the market. Timing the market is notoriously difficult and often counterproductive. Stay invested, stay disciplined, and let time work its magic. Consistency is crucial. The bottom line is this: the future is uncertain. No one can predict it with absolute certainty. But the S&P 500 has a long history of overcoming challenges and reaching new heights. It has shown resilience, so don't give up on the market. Stay hopeful and keep your eyes on the horizon. Just be smart, be strategic, and be prepared for anything. With the right approach, you can navigate any market condition.